Good to see you. Hey, Will. Great idea.
Oh, hey.
How are you, man? You guys have got it figured dude, I'm surprised you're here. I'm telling you. I know, I'm going to head start. Hey.
Yes.
No, I watched it a few years ago. Yeah. Green up. So you were with Sarah. So here's my phone. I think any organization so that's take care. Yes.
We're literally like, it's easy. Actually, when I put money in my meter, and then I walk over. Especially from work. Exactly.
So, here's one.
Yeah.
Somebody, whoever is moderating the conversation, like that's their time. Right? So, if you're looking at a half-day program, down that route, once it's we should talk to my other you guys are super happy it's fun. It's not. It's all warm. Yes. That would be. Thank you. I appreciate it. Good. All right. Good to see you, buddy.
Yeah, good.
Yeah.
No problem.
Yeah, I did. So in HR. That's on the phone. Yeah. We kind of knew that was going to happen, so we're ready for it. You know, we're trying to take our here, so we'll figure it out.
Let me introduce you guys actually. So she's my
Hey, how are you? Good to see you.
Good morning, everyone. We apologize for running a little bit late here, but we'll try to get back on schedule. Good morning and welcome to the Bipartisan Policy Center. I'm Bill Hoagland, a Senior Vice President here with the Center, and I have the pleasure of working with the staff here on a number of fiscal policy issues. But from my perspective, none could be more important to me than those issues that support a growing economy that distributes its growth and equitably and fairly to all workers, and provides a fair return to those who take the risk of investing in businesses to provide employment, income, and opportunity, both for today's workers, but also particularly for tomorrow's workers. I think we all know that U.S. capital markets are widely acknowledged to be the deepest and the broadest in the world, providing nearly 4/5 of the debt financing for U.S. businesses. And the proper regulation of these capital markets is critical and impressive and imperative, it seems to me, to ensuring that the financial system that best serves Main Street. We're particularly interested in Main Street, what all this means to Main Street out there and the average American and average businessman. The Bipartisan Policy Center has been focusing on issues of financial regulation, and it's expanding our work, and we're expanding that work into a number of new topics, including reference rate reform, proxy voting, ESG investing. And today, however, we're going to be focusing on the regulation of capital markets with the emphasis of harmonization and coordination of regulatory activities between these two important agencies. We are fortunate to have today with us the SEC Commissioner Hester Peirce and CFT's Commissioner Brian Quintas for a fireside chat. We don't have a fireside, but we have a chat up here anyway with Ben White, Political's Ben White. We are fortunate also to have a panel that will follow that represents a diverse set of views on the many of the issues that the commissioners will be discussing. Unfortunately, Debbie Totis of J.P. Morgan had to pull out here at the last minute due to scheduling issues. And finally, I want to particularly thank our partner for this event, the Managed Funds Association, for help putting this event together. I was commenting last night, I couldn't believe it. This young lady over here was up here ironing this thing because it had wrinkles in it, if you can believe that. And she wanted, so thank you very much, Adriana, for doing that. With that, I want to introduce the president of MFA, Congressman Richard Baker. Richard Baker is the President and Chief Executive Officer, a role that he assumed in February of 2008. He was previously a member of the U.S. House of Representatives, serving Louisiana's 6th Congressional District since 1986. And he was first elected to the Louisiana House of Representatives in 1971 at the old age of 23 and served for 15 years there. So thank you, Congressman. I'll turn it over to you.
Thank you very much for that kind introduction. Let me clear up something first. But when someone says you're in politics and you're from Louisiana, it engenders some thoughts that perhaps are not constructive for my presentation. So let me get it out of the way. I was 15 years in the state legislature, almost 22 in the Congress, so 37 years of elected service in Louisiana, and most importantly, without an indictment. Now, to most of you, that doesn't sound like an accomplishment, but believe me, back home, that's a really big deal. So I certainly want to add my appreciation to both commissioners for their willingness to work together and to take their time to participate in this event today. Also would be appropriate to acknowledge that the chairs of both agencies in discussions with MFA over many months have been very forward-leaning and very interested in hearing perspectives about how one may enhance the regulatory structure. And of course, the Bipartisan Policy Center, it is our pleasure to again work with you on something that is very meaningful and important to the function of financial markets. This is the type of thoughtful and substantive conversation that we are always willing to partner with BPC. I've been at MFA now going on 12 years, and we've had our challenges. I came to this position in February of 2008, and that is a year which is difficult for all of us to forget. But I must say, despite the challenges, the opportunities have been much more than I could have anticipated. The reality is that by diversifying portfolios, managing risk, and helping deliver reliable returns, the industry has matured and in partnership with many institutional investors has transformed over that 10-year period. We now find that almost 60% of our assets under management come from those institutional investors. And we are now, subsequent to Dodd-Frank, a thoroughly regulated industry with disclosure requirements that parallel any other financial industry. What is amazing to me is how many individuals benefit by the skills and hard work of our industry managers who frankly don't even know, as a retiree, their assets are invested with our managers. It was barely 8 years ago when both agencies inherited the responsibility to oversee us, and the development of policy and the disclosure requirements required have continued to grow and modify. In the intervening period, there have developed certain redundancies, certain differences, with the goal being very similar: to provide adequate and thorough insight by the regulator into the functioning of these markets. But it seems that taxpayer time, money, and resources could be better utilized with thousands of hours of reporting and literally millions of dollars in expenditures that could be realized as savings if the agencies were able to find a way to better coordinate. And that's why I'm so delighted. The last time we had a conversation about this collaborative possibility was 2009. And so to wake up to a world where we have commissioners from both agencies, the chairs of both agencies, and engaging in constructive conversation about identifying those areas where it truly might be helpful to market function is an exciting possibility for us. We have proposed that regulators establish a primary regulator safe harbor. Now, this would not at all, in our view, constrain the right or authority of either agency to act as they view needed or necessary. But it would allow us to register with a primary regulator and maximize their resources and their demands on their time to maintain a complete and thorough oversight of any private investment manager. We have recommended ways to streamline and harmonize the forms, and there are forms and forms and forms. The time spent to get your systems into compliance to appropriately, with good intention, report on a timely basis is very expensive, very detailed, and unnecessarily convoluted. So I am delighted that this conversation is taking place today, and we truly look forward to providing answers and insights that we hope are constructive for the regulatory process. We first came to support voluntary, mandatory registration before Dodd-Frank was even considered. So MFA has been in this pew for a long time, and we want to be a constructive, helpful partner, because ultimately the beneficiaries who rely on our skilled managers to perform their services are millions of retirees across this country who don't have the first idea about what it is their manager does, or even the fact that their resources are invested in a private manager world. So it is quite important work, which will have consequences far beyond our time. And so I am delighted that in particularly the fractured Washington in which we find ourselves working today, that there's an ability to reach across the aisle, hear each other's thoughts, learn from each other, and develop the best standard of public policy. It's a delightful opportunity to be a small participant in this process. With that, I'm happy to turn the mic back to Bill.
Thank you, Congressman. You just described the mission of the Bipartisan Policy Center. Thank you very much. Will Ben and commissioners please join us at this non-fireside? Moderating our discussion with the two commissioners this afternoon is Ben White. Ben needs no real introduction for anybody that is following this area of endeavor and issues. Ben White is Political Pro's chief economic correspondent and author of Morning Money, a column that covers the nexus of finance and public policy. Prior to joining Politico in the fall of 2009, Ben served as a Wall Street reporter for the New York Times, where he shared an award, the Society of Business Editors and Writers Award, for breaking news covering the financial crisis. He's going to have a chat with the two commissioners here. Then we are going to open it up for some questions from the audience before we turn it over to the next panel. So Ben, take it away and introduce our guests from the various agencies.
Thank you very much. As you said, I'm Ben White from Politico, and so far I have also managed to escape indictment, though we'll see if that holds for the rest of the day. Thank you to the BPC and MFA for having me and hosting this important conversation. Hopefully we'll get some interesting insights into the nature of these two commissions and the extent to which they can harmonize themselves. Hester Peirce, a commissioner from the SEC, Brian Quintenz from the CFTC. So let's just jump in and talk a little bit about kind of the reason that we're here, and that is how much more harmonization there can be between your two commissions. And I guess I'll just start with you, Hester, and ask you what are the most promising areas for harmonization? And I'm thinking specifically, as Congressman talked about a little bit, the idea of duplicative dual registration. Is that burdensome? And then systemic risk reporting. Is there too much duplication in those two things? So we'll start there, I guess.
Okay, great. Well, thank you to the MFA and Bipartisan Policy Center for the chance to be here today to be part of this conversation. And thanks, Brian, for being willing to join. So I've enjoyed working with Brian. I think we started out working together on Title VII issues, which relates to swaps and security-based swaps. The CFTC got out quite far ahead in running out of the gate with lots of rules, and the SEC was a little more measured, I would say, in its approach. And so we have the benefit now of the CFTC's experience, and so I think we're trying to draw from that experience in fashioning our own rules and moving forward and getting those finalized. And in that process, we're looking for ways that we can harmonize as closely as possible with the CFTC. And so that's been a big focus of the work that we've been doing together. But I think there is room in these other areas for thinking about ways where we're overlapping, and I don't see any need. Both of us are strapped resource-wise, so I think we're looking for ways to economize, and it makes sense to the extent possible, whether it's overseeing registrants or in the reporting function. I think it's really it's trying to make it easier for folks who are reporting to us, and I think there's a lot of reason for streamlining. So we're open to that possibility as well.
Okay, I guess I'd ask you the same question, Brian, about
sure.
Areas of harmonization and specifically on dual registration, what you're doing on that front.
Yeah, well thanks, Ben, for being here, and thank you, Bill and Mr. Baker, for hosting the event. So it's a pleasure to be here to talk about these issues, and I guess I also like to thank our respective chairmen for being so engaged on these topics, and for not just delegating the work to us, but empowering us to try to solve problems here. I think we have made some progress, and I think we can make a lot more progress. This effort started small. There was a lot of low-hanging fruit that could easily be addressed. An example that I have used in the past is each of our approaches to the designation of special entities. Dodd-Frank required that certain entities needed extra protections when being engaged with swap dealers. That mostly applies to kind of local small government entities, but it also applies to church plans, religious groups, pension funds to some extent. Each of us had a different approach. Each of our agencies had a different approach to how our swap dealers or our registrants needed to identify church plans. The SEC had a position where a church plan was automatically included as a special entity unless they opted out. We assumed that they weren't a special entity unless they opted in. So that created a headache for our dual registrants. It created confusion among the participants in the market that the law and the statute was designed to try to help. And we looked at that issue, we picked one method, and we agreed to go forward with it. The issues get more complicated from there. Each of our agencies have a different perspective and different markets that we regulate. And I think we are bringing those perspectives to this conversation, respecting each other's perspectives in this conversation. But ultimately, I think we need to realize if we do something different, is one way acceptable to the other? Are there things that each of us can do to allow the other to use the approach that's agreed to? And make the process more about sharing between the agencies as opposed to dual filings or repetitive or duplicative filings. Mm-hmm. From a systemic risk basis, and the MFA's perspective specifically, Dodd-Frank looked to us as market regulators to try to judge the landscape of systemic risk from private funds. And each of us set a threshold of $1.5 billion as a systemic risk threshold for private funds. Now, I started my career in Congress, but I'd moved into asset management. I ran my own firm for a little while. Never say never. I don't see a situation where a $1.5 billion fund is going to bring down the financial system that isn't already regulated in another capacity, either through the exposures they would create to the banking sector that the bank regulators need to manage, or if they develop a lot of derivatives exposure, they would also then be registered as a swap dealer and fall under our jurisdiction. So from my view, the systemic risk mandate of private funds needs to really be calibrated to an existential threat that it could cause to the financial system. And I think that threshold is multiple times higher than what we've agreed to. Mm-hmm. That then also implicates what information we request from private funds and from the registered investment community. Right now, I think there's some information that we request that's more academic, that's not necessarily disclosure driven, that's not necessarily examination driven through the mandate of the investment manager. So I think we need to rationalize that as well. And the last issue is differences in timing in terms of when this information is reported. We have different timing calendars for our funds to report that information to us, which makes it very hard to aggregate that information from any type of systemic risk perspective. So that's, I think the start of the conversation there. There are going to be more challenging conversations, from that to see what progress we can make. The form in question here was done through a joint rule by the CFTC and the SEC, and that takes its own progress or process and takes its own amount of time. So there are challenges to trying to rationalize some of these things, but I think we can. The purpose that that we have is to start the conversation.
Right. I want to say that I see some reporters out there who are interested in crypto, and we're certainly going to get to that because I'm interested in it too, even though I fear it and don't understand it fully. But Hester, I wanted to ask you about what the Congressman said about the safe harbor possibility for a primary regulator. Is that a good idea? Can you execute on that? What is your feeling?
Yeah, I mean, I'm open to that idea. I will say I need to go back to pre-crisis, and the MFA was calling for mandatory registration, and it was an area where I always thought it was a mistake to call for it. And I said at the time, be careful what you ask for, because when you ask for mandatory registration, it doesn't come with just a nice little simple form that you fill out and you check and you say, I'm registered. It comes with lots of work, and that work grows over time. And I think that we've seen that. And so I would prefer to be in a world where we didn't have mandatory registration of managers of private funds, but we are where we are. So given that we are where we are, I think we want to make it as effective as possible. And to Brian's point, I think the systemic risk, trying to figure out where the systemic risk comes from this part of the industry is difficult. It's certainly not at the levels that we have it set now. So I think in putting together Form PF, the SEC and CFTC, and then there was input from other regulators as well, from the Fed, from OFR, I think people were sort of trying to figure out what exactly the systemic risk was that we were talking about, and so they just threw in everything in the kitchen sink with the idea. I think there is also, hey, this would be interesting information to have, so let's just ask for it. And so given that, I think we can definitely think about paring back the information that we require. But then to the point of whether we can allow for some kind of safe harbor where if you're primarily examined by someone else, you don't have to be examined by the other agency. I'm certainly open to that. I think it doesn't make a lot of sense. At the SEC, we've got investment advisors registering in record numbers, and so we have quite a big responsibility in trying to oversee all of those investment advisors, and to the extent that we can economize there, I'm certainly open to that idea.
And if you mentioned that the number where we are, 1.5 billion, is way too low. Do you have a sense for?
Well, again, I mean, I'm still trying to figure
in?
out where systemic risk comes from from private funds, because private funds they're not banks, and I think we tend to look at them as if they're banks. So I'm still puzzling over where the systemic risk comes from in this area, so I don't have a specific number.
What do you think about that, Brian, in terms of where the systemic risk comes from and what the number might be, if there is one?
I don't have a number. I mean, I think if we had to pick a number to meet a mandate of a statute, it has to be very, very high, much higher than 1.5, tens. But I fundamentally, philosophically, I agree with Hester. I mean, the way you create an existential crisis to the financial system is through exposures to the banking sector. Right. And that's already regulated by the banking regulators. Mm-hmm. Or through derivatives exposure somewhere else that's somehow linked to the grease of the financial system that would therefore be regulated under a swap dealer registration. So, I mean, we have to see what the mandate of the statute really requires there, but I don't see it philosophically or in reality.
Okay. Let's talk about cryptocurrency for a minute, because I was doing a little bit of research, and Hester, I saw you referred to as crypto mom, which, you know, I've interviewed Chairman Giancarlo at the Milken Institute, and he's crypto dad, so now we have crypto dad and crypto mom.
Yeah, someone suggested that someone should introduce the two of us.
Yeah, exactly, right. You like superpowers activate together. So I wanted to ask you, Hester, whether you think the SEC and other regulators generally take a too restrictive approach to cryptocurrencies, and then we can get into ETFs. But let's just start with a general overview of, is regulation in this area burdensome, too restrictive from your perspective?
Well, I don't know if restrictive is the word that I would use. I think I would use too confusing and not. I think we need to do a better job in explaining to people how our rules apply to this sector. It is actually an area where I think Brian and I are interested in working together as well, because I think there's, you know, there are questions about where your jurisdiction ends and ours begins. And again, we don't want to have overlap there. So, you know, my main concern has been that I think we need to do a better job providing guidance. You know, obviously a lot of people are out there raising money and just calling it crypto and saying, oh, we can avoid the securities laws, and that's not what I'm talking about. But there are areas, there are gray areas, and I think we need to do a better job in sort of laying some groundwork for how someone would come to decide which side of the line they're on. And so I hope that we can do that. Now, I think we have been, at the SEC, we've been unwilling to, for example, sign off on a Bitcoin ETF, an exchange-traded product based on Bitcoin. Thus far, we haven't allowed that. And my concern about our approach in that area is it looks a little bit like a merit-based approach, judging the underlying Bitcoin markets and saying, oh, we don't think that these are regulated enough. Well, you know, there are lots of markets that aren't regulated, but we nevertheless build products on top of them. And so I think we have to be very careful with that kind of reasoning.
I have the same question for you, Brian. I mean, who should be regulating this? How do you divide up the responsibilities for it? And then, you know, when are we going to get a Bitcoin ETF?
Well, the second question isn't in my jurisdiction. That's purely for Hester. You know, there are some considerations there through the experience that we've had through the listing of Bitcoin futures contracts by 2 exchanges. You know, we have a process in the Commodity Exchange Act that allows the exchanges to self-certify a contract if they believe it meets the requirements of the Act. We have a review period in which we can say, no, we disagree with you, and here's why. But if we don't disagree, they have the opportunity to go ahead and self-certify that contract. And both exchanges pursued that self-certification. So these contracts get listed without our approval, but also without our disapproval that it doesn't meet the terms of the statute. Our jurisdiction over those contracts requires that they not be readily susceptible to manipulation. So it's not be manipulated in any capacity, because that's, I think we can all acknowledge that with a certain amount of time and a certain amount of resources, almost anything can be manipulated. Then there's the question of how easily can we discover it, and usually it's very easily. But there are mathematical ways through a settlement index to design a contract where even if there isn't a lot of liquidity on one exchange that's referenced, the index itself is not readily susceptible to manipulation. For instance, in one of the Bitcoin futures contracts, they settle it to multiple volume-weighted average prices in 5-minute increments over the course of an hour across multiple exchanges. So if one participant wanted to manipulate that settlement index, they would have to have the majority of volume on multiple exchanges in multiple 5-minute periods. Could they do it? Maybe. Would we know about it? Immediately. So, you know, I think there are things that there's value we can add to the conversation in terms of how some of these things have been constructed that prevent our concerns of manipulation from being present in the marketplace. But back to the regulatory landscape, you know, there's the difference between the commodities and securities is significant, because we only have fraud and enforcement jurisdiction over the commodity space. Our oversight jurisdiction is over the commodity derivatives space. So the trading of commodities themselves, think like eBay,
Yeah.
we don't have any type of oversight over that. And I think that that's
This is the spot
interesting
market
and
we're talking
appropriate.
about.
Spot market. So, but that also means now that you have very large platforms. I don't call them exchanges, I call them platforms. Platforms that are trading in an enormous number, volume, quantity of commodities that have no necessarily oversight standards. And that's not necessarily a bad thing if they can implement a free market approach to solving those problems. But because of our lack of statutory oversight capability, I've suggested that these platforms come together to form some type of self-regulatory structure where they can discuss, agree to, implement, and hopefully examine or audit themselves, through an independent third party or for however they view as appropriate, to some level of standards, from conflicts of interest, business conduct, insider trading, redemptions, custody, liquidity. That's an evolving landscape. There's been some interest in that concept. I'm encouraged by the progress. I kind of view it as a 400-meter dash, and they view it as a marathon. And I think hopefully it might be somewhere in the middle. It'll take some time for sure, but I'm
This is sort of like a FINRA for crypto, the crypto world is what we're doing.
Yeah, but just as a distinction, FINRA and NFA, and I know NFA specifically, but a self-regulatory organization is specifically chartered by Congress through the law. This would not be. It would just be a mutual association of private industry.
Yeah. I guess, Hester, how much does it matter, the definitional nature of something like Bitcoin? Is it a method of payment or is it a security? Because it seems to maybe be both, but nobody really uses it as a method of payment now because, you hoard it and it becomes worth more, or in my case, when I bought 1/23 of a Bitcoin, it became worth a lot less. Does it matter how we define it?
Well, people do use it as a payment system, not necessarily in the U.S., but I think there are other places where it is serving that function. But it does matter how we define it, just because if we define it as a security, a whole raft of regulations follow that definition. So, I think Bitcoin is probably not the example that I would use for where there's a lot of gray, but there are other cryptocurrencies where that line is much more difficult to draw, and it really does matter because it matters when you sell it. Is it a securities offering? And if it's a securities offering, you better do it in accordance with our regs or under an exception. Otherwise, you're subject to having to do a rescission offer, which is not something that's welcome. But that's the reality of the rules that apply.
And how much abusive behavior is going on in the initial coin offering area?
Well, I think everyone is. There was this big rush of people to do ICOs, and there was a rush of people wanting to throw money at people doing ICOs. And so if someone's willing to give me money, hey. A lot of people had the attitude of, all right, I'll take your money, and I'll throw out a white paper and I'll take your money based on the white paper, and then I'll take the money and go to Maui. So certainly that's going to happen at the beginning of any trend like this, and I think people have started to say, all right, before I give you my money, I want to see your white paper, and I want to understand that your white paper actually matches what the code says. And I want to think about what the background of the people who are promoting this ICO, what are their backgrounds? And so there's a lot more, I think, question asking, and there's a lot more analysis going on now. So I think you're going to see money flowing toward ICOs that are legitimate projects more than not. But as with anything, investors need to ask questions, or anyone buying anything, ask questions before you give someone your money. So I think some of these standard lessons that we teach people apply equally well in this space. But I think there's also a lot of promise, and it's a group of people who have really interesting ideas about how a lot of things that we've done one way might be able to be done a different way. And I don't want to lose sight of the fact that there really is a possibility that we could improve people's lives in the way people interact with one another through this medium of crypto. And so I don't want to lose that through just thinking about the regulation.
Fair enough. I could go on for crypto for quite a long time. I won't, because we have about 9 minutes before we're going to take some questions from you all. So think about what you might like to ask these two people. But I did want to get to LIBOR and reference rates and the idea of a replacement for that, given the abuses that we saw. And I was interested, the Journal had a story yesterday that this potential replacement, the SOFR, has been pretty volatile, raising some questions about whether it is a good alternative to LIBOR. I would just, I guess, maybe start with Brian, and then Hester, where are we in the process of LIBOR replacement?
So I think that Journal article was interesting for a different reason, which will remind me to come back to, but sure. I wanted to kind of start more of the beginning of the landscape here. So in 2014, the New York Fed convened the Alternate Reference Rate Committee, the ARC, and its goal was to agree to a new benchmark standard that would replace LIBOR that was market-based with a lot of transaction volume. And you think about that for a second. LIBOR underpins $200 trillion of contracts, and it has $500 million of daily transactions. So a very, very small amount of market-based transactions underpinning a very large amount of contracts. So the ARC came up with the SOFR rate, the Secured Overnight Financing Rate, as their recommended replacement. And following a speech by Andrew Bailey of the FCA over in the UK, when he said come 2021, he will not require banks to submit LIBOR bids anymore, and therefore LIBOR will go away, the ARC was reconvened by the New York Fed to develop an implementation plan and a transition plan to SOFR. So right now we have a huge education process in terms of getting the word out to all market participants. You know, the large players, the big banks, they sit on the ARC. They're taking a leadership role here. But there are continuing to be issuances, especially in the cash market, that are tied to LIBOR. And out of that $200 trillion of contracts, 95% of those are actually in the derivative space. A large number will mature by 2021, so we won't necessarily have to worry about that, but there will still be a significant amount that we will. But $8 trillion of cash market products, consumer loans, business loans, syndicated loans, mortgages, securitized products. You think about, there's going to be, and out of that $8 trillion that exists now that's tied to LIBOR, about $4 trillion will continue to exist, will not mature by 2021. And you think about the process of changing the covenants of a syndicated loan, where it's going to take all the parties to agree to something. That's going to be, it's kind of like Apollo 8, right? Changing the mission from orbiting the Earth to orbiting the Moon in a matter of months. This is the financial markets Apollo 8, I think. So it's going to be a big deal. And we only have 2.5 years to do it. But back to the article from the Journal, which I thought was interesting. I have read and I have heard, although I haven't studied, the fact that it could be actually tied to a regulatory capital requirement, that the G-SIB surcharge imposed on largest banks is done on an end-of-year basis, which means that in order to rationalize that from their perspective, as opposed to looking at their exposures over an average period of time, and all banks report average balance sheets. Right. That's how analysts get an idea of their net interest margin. The prudential regulators calculate the G-SIB surcharge on an end-of-year basis. So therefore, there was a balance sheet scarcity issue come the end of the year, and you had repo overnight financing rates just shoot through the roof, which then translated into a corresponding increase in the volatility of the SOFR contract. So I think there are multiple things that can implicate that volatility that can hopefully inform policymakers and see if we're still doing things all the right way.
Hester, thoughts in this area of?
Well, I think Brian described the problem very well, and I think it's one that we're working with the industry, trying to, as you say, the large players are very aware of the problem, but LIBOR is infused through so many different contracts, through so much of our economy, that I think it's incumbent upon us to keep getting the message out that this is really an important change happening, and people need to be aware and start thinking about what their plan is for dealing with it.
Yeah, I wanted to get a little broader. One thing I always like to ask regulators when I'm talking to them is, what worries them in terms of, the next crisis, systemic risk. Seem to be in a pretty good spot in that regard, but there's always something that comes up that we, weren't really prepared for. When you think about threats to the system right now, systemic risk in the system, do you see it in any particular place? What worries you in, the way our markets are functioning now?
Well, one area is that we've, Title VII of Dodd-Frank put a lot of emphasis on central counterparties, central clearinghouses, and so we've created these very big, very important institutions. So I certainly think that's an area where we have to watch out for what's going on. But more generally, I would say a concern that I have about much of the regulatory reform that followed the crisis is that it seeks to apply uniform rules across the board to everyone, and I think what you could end up with is homogenization, which means that when there's a problem, everyone's going to be suffering exactly the same problem because everyone's going to look exactly the same. So I think it's really important to remember that we have a lot of variety, and that's a good thing, because if you allow, you set broad standards and allow people to meet them in different ways, you're going to have a more robust system, which is another reason why I really like the space that we regulate, because capital markets are inherently diverse, and that's the whole point with asset managers. They're managing according to their own approach, and so we get a lot more diversity in this space, and I think it's really healthy for the financial system.
Mm-hmm. What about you, Brian?
Well, I think building on Hester's point on both diversification and central counterparties, clearinghouses, she's exactly right. We've taken the idea of central clearing and supersized it by putting swaps industry through that. And while I've gotten very comfortable from where I said over the last year and a half in terms of our regulatory practices of overseeing and examining and stress testing clearinghouses, there is an issue in terms of how that risk is diversified. The clearinghouses don't eliminate risk or reduce it, they mutualize it across their membership. And we have seen a significant consolidation of the membership bases of clearinghouses as firms have gotten out of the derivatives business, either from an expense or a capital or compliance perspective and an economics perspective. And so what we're doing is we're supersizing clearinghouses at the same time that the membership of the clearinghouses is concentrating. And I think that's going to be a dynamic that we have to be aware of and keep on top of and see if there are ways to either rationalize the rules for the membership so that we are not precluding new entrants from coming into that marketplace, or thinking about it differently. When I ran my investment firm, and before that when I was at another investment firm that was focused on the banking sector during the financial crisis, I sat through the European sovereign debt crisis of 2011. And not necessarily speaking to any geography in the world, but the idea of sovereign debt and banks holding, a significant amount of their own jurisdictions' sovereign debt when countries don't apply GAAP, don't have the most transparent balance sheets, and they have products that are tied to that sovereign debt that do proliferate through the system, through the derivatives industry. I'm not sure that there's a preventative step we can take there, but it's something that I keep thinking about.
Got it. Good. I have a pile of other questions, but we're out of the 30 minutes, so I'm going to turn it over to you all for any questions you might have for our two commissioners. I would just ask, we've got mics around, that you would just say who you are before you ask your question, and please just ask a brief question and no speechifying, which I sometimes run into at events. Who has a question for either of these fine people? We've got a question here. There's a mic.
This one's for Commissioner Peirce. Chris Marquette from CQ Roll Call. You've been very critical of Form PF in your past speeches. I was wondering, do you think Form PF should be eliminated? And just a little bit of context on that. Last summer, the SEC announced that they took an enforcement action against over a dozen private funds for failing to fill out Form PF, some for a period of 5 years. And I was wondering, do you think the SEC is not doing enough to actually, research and understand the data that they're getting from this form? I mean, they're clearly, in some instances, not keeping on top of the reporting requirements for Form PF.
Well, I wouldn't say that we're not keeping on top of the reporting requirements. I mean, there's a question of when you bring an enforcement case is always a discretionary question. So to that point, but in terms of whether or not I would eliminate Form PF, if I were running the world, there wouldn't be a Form PF. But Congress has asked us to do it. So Congress is much closer to running the world than I am, so I listen to what Congress says.
So you say, I don't know about that.
But yeah, I mean, I think that we need to think more carefully about what information we're collecting, and then to your point, we need to use the information that we get. So if the strange thing about that form is that it really wasn't designed for either us or the CFTC. It was really designed for the systemic risk regulators. And so it's a little odd for us to be trying to figure out what they might need. But to the extent that we're taking in the data and looking at it, we should be having, there should be a purpose for us in looking at that data. So we should use the data that we get.
Not to take too much time, but any changes to Form PF would have to be adopted jointly. And let's actually go through, an assumption or a scenario where you got rid of Form PF. Firms still have, at least in the CFTC space, a quarterly filing obligation to NFA to file information with them as the SRO on a consistent basis that they use for all of their examination purposes. So whatever we may or may not do to Form PF, there is an extensive amount of reporting that still continues and that would still impact our ability to understand data and be a market regulator.
Okay, thanks. More questions? I've got more if nobody else does. There's one here. So just grab the mic, tell us who you are.
I'm Mark Sheff with Investment News. I hope it's okay to ask a question that's not directly related to this panel, but for Commissioner Peirce, what do you foresee as the timeline for regulation best interest? Which way are you leaning on a final regulation, and what will determine your vote?
Reporters aren't allowed to ask questions at this event. Well, Reg Best Interest is a priority of the chairman, and it's also a priority of mine, so I'm looking forward to seeing it get done. I don't have a timeline for you. The shutdown did affect a lot of things, and it affected rulemakings as well, so that does have an effect on Reg BI as well as other rulemakings. In terms of what way I'm leaning, I mean, I'm still meeting with people, listening to people, welcome people coming in and talking to me about it, but I do think that it's important that we move forward with the rulemaking.
A question up front.
Hi, Trent Reasons with Boston Consulting Group. On the LIBOR topic, I kind of wanted to get a sense of, you astutely outlined how it's a plate tectonic shift. It's a major transition. One of the things I hear a lot from my clients in the banking and trading world is, where are the carrots and sticks? Where are the incentives or prohibitions to adoption? Because, it's like LIBOR's dead, long live LIBOR. It still trades. It's the deepest market in Eurodollar futures and swaps. There's been some nascent kind of issuance amongst the GSEs and SOFR, but there's really a big question about, number one, why should I really adopt as an institution? And number two, the feeling that there's a center of gravity more in FCA UK, with respect to this issue, and a feeling that the U.S. is sort of a laggard with respect to this issue, given Bailey's CEO letter and the call for risk and information from different firms. Could you talk a little bit about maybe the coordination with those folks and some of these incentive problems that have arisen from a policy standpoint?
Well, I see your point in terms of could we provide more incentives through, punitive regulations or decisions or enforcement measures. First of all, I don't know how we would do that and how that would be structured. But I'm not sure that we need to get there. I think the incentive is that this is going away, and that at some point it's going to be very hard to manage to it. And I think, to your other point about, cash market products, I think, we could see more of a leadership role of some of the very large issuers of things like student loans that are still being issued to LIBOR, transition away from that. The other issue that we need to consider is that there's the chance that this has a political element to it. If folks, and banks, change the terms of their clients' mortgages, and all of a sudden someone's payment goes up by $50 a month, there are going to be a lot of members of Congress that are getting phone calls about this. So there's a big education initiative that needs to go on with policymakers as well. But I think Chairman Giancarlo's been very clear. I've been very clear. My counterpart of the Commission, Russ Benham, who's taken a leadership role in examining these topics through his sponsorship of the Market Risk Advisory Committee, has been very clear. We are moving away from this, and eventually we may have to consider those options.
Yeah, I do wonder about the stick part of this. Like, what is the stick? How do you make people do this?
Well, I think, thinking off the top of my head, because I haven't talked to a lot of our staff about this, but I think it may get back to our regulation of contracts that are tied to an index that's not readily susceptible to manipulation. If that index is so thinly supported or is deemed as invalid by the regulating authority in the UK, I think that could have a big influence in terms of how we view the sufficiency of contracts that reference it.
Okay, we've got time for a couple of more if anybody else has one. I can ask a couple more. Was there one back there? No. I wanted to ask you, Hester, about some of the comments you've made in the past about the SEC sort of favoring large issuers over small businesses and making it more difficult to raise capital if you're not large. What progress have you made in that area? What are your thoughts about it now in terms of, I think you referred to it as the SEC putting its thumb on the scales in favor of big over small?
Well, I think we have a lot of work to do in that area. We just had a good development, which is Martha Miller joined us, and she's our advocate, our new advocate for small business capital formation. That's a new position that Congress created, and I think the SEC has historically just been much more focused on large issuers trying to raise funds, and her role is to really point us in ways that we can make our regulatory framework work better for smaller issuers. And I think that'll be very helpful just to have the nudge from within the Commission on that score. But it is something that the chairman cares a lot about too, and so I think he is, along with his director of Corp Fin, who comes from Silicon Valley, which I think is helpful, Bill Hinman, they've been working hard to try to think about ways we can rationalize our disclosure rules and our offering rules and other types of things. So I think we are making progress.
If there aren't any more questions from the audience, we'll thank our two commissioners very much for their time. Really appreciate the discussion. Thank you. That's fun. Good to meet you. Yeah, appreciate it. Yeah. I'm just inviting panelists. Yeah. Okay, we're going to jump right into our panel to get a little reaction to what we just heard, and welcome Tyler Galash from Healthy Markets, Petal Walker from Wilmer Hale, Jennifer Hand from the MFA to the stage. We'll do a chat between us and then take a couple of questions again at the end from those who are interested. So I guess I would just start off by saying welcome to everybody. Good to see you guys this morning. Let's just do top takeaways from what you heard there. What was, starting with you, Jennifer, what was the most interesting thing you picked up from what you heard from the two commissioners?
So I think one of the interesting things that Commissioner Peirce mentioned was wanting what helps with a vibrant capital market and its diversity. And so I think with the asset management group, with this industry, that's exactly what we're trying to promote. And I think also with what she said with small issuers, well, we have a lot of managers in this field which are small issuers. And so one of the reasons we've been trying to get the SEC and the Cftc to harmonize a little bit better, to coordinate better, is to better utilize their resources. And also, I think this would be a lot of savings for the advisor community, commodity pool operator, funds, and all. And this translates into savings for the pensioners and others who invest in these institutions. And so I think also, when you do that, you are lowering the bar for entry into these markets, which again supports greater diversity, asset diversification, as well as more smaller issuers entering. Because as the cost to enter these markets is very high, these businesses, you have fewer managers coming into this space.
Okay, Tyler.
Yeah, I noticed, and I apologize for saying this with a former member of the Ag Committee in the room, but we're here in part, and the need for coordination is in part because we have two separate agencies here, and two different committees of jurisdiction, and those diverse viewpoints tend to lead to diverse outcomes, unfortunately, and we're trying to say, how can we lead, these two separate processes end up with similar outcomes at the end of it? It's not lost on me that presidents of both parties have talked about merging the SEC and CFTC over years. It's not surprising to me that people who don't spend a lot of time on the ag committees or banking committees or others would talk about those things, and then when you spend 25 minutes with a member of those appropriate committees in a hearing, you quickly recognize that that's a very difficult task. And so, I can be corrected if I'm wrong, but as a former staffer, I remember a few things. So one of the things I would say is the importance of working together. And I would actually also say, to steal from the name of the place where we sit right now, the importance of actually bipartisanship. And one of the things that struck me, the two folks here being the commissioners we just heard, both being GOP commissioners, it was recognizing, and I coming from a Democratic aid background, recognizing the obvious areas of bipartisan agreement and the interest in those things. But I also recognize that there are areas where we're going to have partisan differences, but there are a lot more areas of agreement where we can make some progress. And we'll get into some of those substantive issues in a bit, but I'll say this. That's incredibly important. And I would caution folks today, as we talk about substantive areas, is the importance of actually having the bipartisan buy-in. Because what we've had now, both with Dodd-Frank and, frankly, the rollbacks or various rollbacks, is particularly partisan discussions over many of these things. And unfortunately, what that leads to is change it once, then change it again, then change it back, right? And we've gone through that with the Volcker Rule. We're going to go through that, do we want to change all of these things? Do we not? We're going through the same thing now with CEF regulation, and we can talk about some of those things. So those are my two big takeaways.
Okay.
What stuck out to me was the discussion about cryptocurrency. Currently there is a division where if you are on an established network, there is a pathway for you, commodity. If you're not an established network and you're trying to create one, then you have to deal with whether or not you're a security under the SEC's jurisdiction. And I forgot which commissioner mentioned it, but I do think there's a danger that this paradigm is preventing potentially powerfully innovative methods of engaging in ecosystems from coming to fruition because the business cannot just start with the network. And so I think one area of harmonization that's not only useful in terms of the market, but for our nation to advance, is to be able to create a pathway for viable, non-scam entities that are attempting to get from pre-network to post-network to have a pathway that can actually work. Because the danger is that other countries will advance beyond us if our very regulation prevents us from allowing our citizens who have great ideas to be able to bring those to fruition. So that really stuck out to me when I heard that discussion.
Jennifer, I know the MFA is particularly interested in dual registrations and risk reporting. What did you hear from them that you thought was hopeful in those areas, and what specifically are you looking for changes in those two areas?
Right, so I'm very encouraged by what we've heard. And so again, the last time that the SEC and Cftc, the last time that they came and met together and talked about harmonization was in 2009. And so again, here we are 10 years later. We've gone through the Dodd-Frank Act, implementation of the Dodd-Frank Act. We have more regulation than we have ever seen before by these agencies with respect to commodity pool operators, investment advisors. And again, with these two agencies, the biggest group of registrants are advisors and funds and commodity pool operators and commodity trading advisors. The other thing that's different is that we are at a point where there's more regulation. The agencies are expected to do more than they ever have with limited resources. So it seems like a great idea for them to help prioritize resources, and there's a real willingness now, noting from one of the commissioners, working together to try and work on the economies of scale. And so I think that working together has real benefits for constituents, for the agencies. It will really impact the way they look at regulation. I think that they can work together and save taxpayer money as well, because again, rather than having two very similar systems, regulatory frameworks over commodity pool operators, investment advisors, I think the agencies can continue to oversee both these groups of constituents, yet work together, and so do some of the things together. And so again, some of the forms, we think that they can either harmonize, and so you file one form, because again, if it's to go to FSOC, it will be a lot more meaningful if FSOC can aggregate all forms rather than have two different sets of forms. And again, regulations, inspections, if they can work together or have one take the lead, I think they can save on a lot of resources there. And so I think it's really working together with these agencies and the staff to put together some real policies, and I think there's a lot that can be done, so we're optimistic.
And Tyler, is this all good stuff? Like, I guess I'm asking you from your Democratic staffer background, healthy markets, or are we talking about just making it easier for people to game the system or slip under the regulatory framework? Is all this harmonization talk positive?
Yeah, probably all of the above, right? There are certainly real opportunities for improvement. I mean, we've talked a little bit about Form PF. As someone who's involved with a then Senate aide who later became a Democratic SEC commissioner who was deeply involved in the drafting of that language, as I was as well for Form PF, one of the things I can say is you have to think about what you want a form for before you start saying, like, gee, let's have a form. Okay, what do you want it for? What are you going to do with it? And one of the interesting things, and I think this was highlighted by that discussion, is when the form is a purely government use form. Okay, is the government using it? Then the next question is it even usable? And then you start to ask those really, really basic questions. And I hate to be so openly critical, but the FSOC is not near the entity that 10 years ago people thought it could be or feared it would be, depending on your perspectives, right? Like, so those, depending on your perspectives, the FSOC is not nearly that thing. And the OFR has not nearly been the thing that it would have been or could have been or feared to have been. So I would say, I think it's a perfectly appropriate question to be asking when the government is going to impose a burden on market participants to submit forms. If it's just going to be for the government's use, then you could say, well, what are you going to use it for? And on the private market, there's another question of, why is it just for the government's use? You could make the same extension and go completely the other direction and say, if we think this stuff is valuable, why is this not available to the public, right? Those are two very different outcomes, but I think we have to think about which way we want to go. So I think the coordination on that makes an awful lot of sense, because if it's to the government writ large, then you have to think, what's the use of it? The second question I would say is in terms of substantively what the topics are, whether or not coordination makes sense. So I'll use an example that we heard a moment ago on LIBOR. Benchmark regulation covers everything from LIBOR on one end to a bespoke structured note on the other end. And in between, over the last now half dozen years, we've seen multi-billion-dollar settlements for LIBOR. We've seen it for ISDA-FIX. We've seen it for foreign exchange. We've seen it for structured notes. We've seen it for commodity benchmarks. And so as we go through that spectrum, I think, gee, we have remarkably similar problems across a wide variety of asset classes and benchmarks. In Europe, they just decided to regulate the benchmarks themselves. We're going to do this. Here we have a ton of different regulators thinking about it. So in that area, I think, geez, it would probably make sense for the banking regulators to be coordinating with the Cftc and the SEC, not just on LIBOR, but across the broad spectrum of products, because those benchmarks and the weaknesses of those benchmarks are not just for LIBOR. So those are two areas.
Yeah. Did you have thoughts in that area? I mean, we could talk about LIBOR, we could talk about any number of things, but in terms of harmonization of form reporting, that sort of thing.
Yeah, I think definitely in terms of these kind of simple things like having, not simple, but in terms of having similar forms and things that make life easier for the businesses, it certainly makes sense to harmonize. Certainly, having seen businesses internally as an attorney for businesses, there are tons of firms that are attempting to follow the rules. But they have to create an apparatus to follow the rules that's really just blown out of proportion. And at some point, you have to wonder whether the apparatus is doing more harm than good, because they have to think about not only SEC, CFTC, but across in other countries as well, the jurisdictions and the different rules they have to follow. And so it can become very messy. And it's hard to create a compliance culture when it's not simplified enough for the average firm without having to become a law firm in and of itself to figure out how to actually follow the rules. So that's definitely true. I do think, though, there could be a danger on the outside of that. Some firms, in representing them, one agency may be treating the business of the firm as if it's within its purview. Like, say, for instance, with swaps, right? The average swap participant, unless you're on a DCM, is extremely sophisticated. But sometimes, if another agency is looking at the work of a firm based on an SEC retail investor kind of standard, laws can be created and exams can be done in a way that doesn't make sense for the counterparties or for the product. And so there could potentially be, and I have seen, where trying to harmonize too much could be problematic for a firm if the agency looking at it is using a standard based on its purview that actually doesn't make sense for the kind of products or personnel or persons that the firm is actually addressing. So I'm being kind of vague because you can't be too detailed in terms of clients. Sure. But there is a way in which harmonization without consideration can be problematic for firms in that way.
Jennifer, was there anything in the crypto area that jumped out at you or is important to you in the MFA and people you represent that you heard from either of the two commissioners?
So we've watched the crypto space and we've kind of stayed out a little bit. I think it is important, and this is very representative of the roles that agencies play in providing clear rules to the road as so businesses can flourish. Because I think what you find out there is that people do want to follow the rules. It's just sometimes hard figuring out what the rules are. If I may just take a moment, I love what Petal said as outside counsel and explaining that for a lot of these businesses, they want to follow rules, they want to do what's right, but it becomes quite burdensome, the compliance structures that they have to figure out how to build in order to comply. For example, with the systemic risk reports. But the other thing with respect to dual registrants is having two sets of compliance books. And so I think one of the things we've worked on to address that issue, and again, it's been 7 years now where we've had this overlap, where people are doing things in this very cumbersome fashion. It's hard for new entrants to the market. And we think, 7 years, let's step back. We think there are really good relationships at the agencies with each other. It's a good time to look and see how we can streamline business. How it's a good time to work together. How can we decrease the regulatory burden? How can we make things work better now that we are done just throwing a lot of the stuff together? And so, and on the cryptocurrency, I think a lot of people, especially investors, have shied away from going into these markets. They're watching, but just given some of the rules, custody rules and other things, it's still early days. As I mentioned, a lot of our managers represent institutional money. And so it is trying to figure out what are the rules of the road here before jumping in. So I think more clarity is better.
I was going to ask you, Tyler, you brought up FSOC and that hasn't evolved into what maybe people thought it would. Do we need it? Is there a purpose for it? Like, I know it has, important meetings and Steve Mnuchin likes to, preside over them, and it has reams of data, but...
Yeah, do we need, so it's an interesting question. So I would say, do we need the function that it was designed to serve? Yes, unquestionably so. Does it adequately serve that function now? I would be hard-pressed to find anybody who could answer that with a straight face. Because I'm not sure anybody outside of the rooms, the private meetings that aren't discussed and aren't public, knows the answer to it. There just isn't enough available information, I think, to really assess that. One of the things I think we heard is like, what are you concerned about? And both commissioners mentioned clearinghouse risk, concentration of clearinghouse members, and the idea of the enormous clearinghouses. And I would say absolutely agree. But I would also add a couple of other things. Clearinghouse risk is also, we start to talk about things like capital and margin levels, right? Those types of dollars and cents things. And that's how you typically manage those types of risks. So, the idea of having a large clearinghouse, well, we have those things in other markets and have for years, and the question then becomes, what's the risk? Well, if we think that those are appropriately managed with capital and margin, then we're less concerned. Our fear now is what they're saying, what I heard from what they said is, we're concerned about capital and margin and concentration for those clearinghouses. That, to me, gives me significant pause. Because at the same time, we've heard now for years about capital and margin levels and clearinghouses. Right. So that's one thing I heard. The other thing I would think about is, it's almost every week now we pick up the paper or read a Bloomberg article about corporate debt markets. Yeah. And the sheer number of new issuances, again, remarkably Fed interest rate driven, it seems like, tax policy driven as well. And so when we look at those things and we layer them onto, let's just say now, leveraged ETFs, certain products that are now far more prevalent today than they were a decade ago, those are the types of things where I look at and I hear little warning bells. And I say, so is FSOC looking at those things? They seem to be. Their reports suggest they are.
Like Covenant Light that's coming back, that sort of thing.
But for me, it's a function of, is that role an important role? Absolutely. Right. Is this entity adequately performing that role? And the answer for me is, I have no idea.
What about OFR? Do we need that?
Yeah, that's right. Hey, I don't know. I lost track of them. Yeah. I suspect many folks did as well.
I'd ask the same things of you, Petal, but I would ask also more broadly, like where we are in the, we had Dodd-Frank and implementation, and then we had the Crapo bill and some rollbacks. Are we in the right place now? Have we done the right things in terms of, all of this regulation? And if there's more that needs to be done, what is it?
I think there definitely have been some positives. There's a lot more capital in the markets. There's a lot more transparency in the markets. I think that market participants and regulators alike would agree that these are positive benefits. I think the danger is that, like I said before, creating an apparatus that itself becomes problematic. I do want to say a word about CCPs because, given my background, I cannot not say it. It's true that the risk is concentrated in a certain space, but it's also true that the transparency has gone up tremendously, and I think that matters. The idea that even though maybe the public can't see everything that's happening, the level of oversight or the view that the CFTC has into what's happening with margin and with risk is much more clear, and so and that's a positive for market risk. I do think, though, and going back to my whole interest in technology and blockchain, et cetera, is that we now have the possibility, given where the economy is and given where the oversight is, to take things to another level in which the regulator can get better data and faster data as to what's happening in the market, and then our regulation oversight can be smarter. So I think that the amount of regulation that we have now is probably oversized, but in thinking about how to harmonize, we need to use data and good data to determine how to trim things down in a way that's still potent, though not as burdensome. And I think that the use of things like blockchain technology, having more than one entity being able, to see the market helps with cybersecurity. I think that blockchain on, say, the derivatives markets can allow the regulator to run stress tests all day long versus once a year. So it all ties in for me in that we should be allowing these new technologies, the openness, the space, the flexibility to actually improve our ability to have efficient markets, which ultimately is what the regulator and the market wants.
Tyler, do you subscribe to that view that most of the operators in the crypto space are well-intentioned and most?
Anybody who follows my Twitter feed knows where I am on a few of these things. I tend to find interesting ones, be it from particular issuances to particular providers. But one of the things I think is important is, if you go back in time, the ethos of a lot of crypto it's sort of a more libertarian, not need of government intervention and role of government.
Or as a replacement for government intervention.
Correct. Yeah. So when you start thinking about the ethos there, and you start laying on, unfortunately, many of those firms did not have as competent legal counsel, I think, but also sort of come to it. I mean, it's literally every day there seems to be another firm. We have a firm, and I won't use the name, but there's a firm that seems to be offering what appears to me to be an equity swap, and says, but this is based on, you deposit $1 here, it goes into this, this cryptocurrency, then it gets converted to an investment in an equity over here, but don't worry, none of this is regulated by the SEC or CFTC. That's fine. And you think about what that looks like to a retail investor or even a sophisticated investor. I'll tell you, very sophisticated counterparties, for example, several of our members at Healthy Markets, are engaged in equity swaps all day long. Right? They know what an equity swap looks like. And so when you juxtapose where some of the technology firms are and some of the crypto firms are against an existing regulatory structure, sometimes they line up in ways that really aren't all that novel, right? It's actually just a new package and saying, gee, none of this applies to us. I think that's what's falling out of the market now. I mean, that's the thing. We're in the washout period for that. The next part is all of the firms that really do want to comply, trying to make that reasonable for them. Because I don't think we've spent any time worrying about that. At the SEC, it was for ICOs is a good example. The SEC took the approach of essentially sitting on it. A lot of coin offerings went out the door. And then, gee, we have concerns. Then there was a couple of speeches of concerns. And then, bam, we've made the decision. And now everybody's sitting there saying, wait, we were trying to comply. We got a good legal counsel opinion, 9 months ago. We made this offering, and now you're telling me I was a security offering we were not registered. So what do you do? What do you do with the investors in those things? So I think that we are in a washout period now for a lot of crypto, where a lot of the legal structure is taking place, and we'll see where it goes from there.
Do you think, Jennifer, that somebody mentioned the efforts to merge the SEC and the CFTC that, president after president says it's a good idea, goes to the Hill, and the committees say, nah, not such a good idea. Is that still something that's hoped for in this world, or have we just given up on the idea that there will ever be a merging of these two regulators?
I think we've moved beyond that. I think during Dodd-Frank, if it was going to happen, it would have been there. Happened, yeah. But I think now the other thing, again, so it is what can we do to work with both agencies, and given all of the things coming together, I think it is, concern. It just so happens how the U.S. structure is that you have commodity products, commodity derivatives, agriculturals and others regulated by one, energy, metals, and then you have securities by the other. And so the U.S. is unique in that sense, whereas in a lot of other countries, younger financial system, they have one regulator. But since here in the U.S., given our structure, I think making the most of it, it really requires greater coordination. And so there are different focuses, but with greater coordination, discussion, and I think we certainly see that more at all levels within the agency. It helps that the chairman feel strongly about this, that this is something that they've prioritized, that the agencies should be able to work together. The Treasury, certainly in its report to the president on capital markets and the recommendations, has recommended that there be greater coordination and working together, and so that there is harmonization. And so we've picked up and tried to move with that, knowing that the agencies have limited resources. We've provided recommendations. We've carried the Treasury's recommendations and moved that more to here's exactly a proposal of how you could do that to help move things along. And so again, I think that there is a willingness between the two agencies, the commissioners, the staff, and it is continuing with that thread.
We've got about 5 minutes for questions. If you all have anything you'd like to ask our very smart panelists up here, I'd be happy to recognize you. If there's one right here. Double dipping.
Double dip. I'm putting my whole mouth in the dip to from Seinfeld.
Just take one dip and end it.
Just one dip and end it. Thank you, panel. I think a lot of the conversation has begged this question of why the SEC and CFTC are separate and why not combine them. A lot of clients that I work with complain about similarly the issue of we're running a zone defense and it's too many different regulations and too many different reporting. At the same time, I think there's also a concern about if man-on-man coverage is the game, it's going to be a lot stronger. So how political considerations aside about funding and appropriation for those agencies and their committees, which is like saying don't breathe and run the 40 and 4, but how should we think about not just ways of cooperating, but is it a just wishful thing to think that these agencies should combine and become kind of one power?
I'll take the first stab at it. So somewhat famously or infamously, the Volcker Rule had 5 regulators put in task of writing the rules. And as the legislative drafter, a staffer who pushed very hard for that, I can tell you that hasn't always been ideal. So, I think Petal made a good point earlier, is be careful what you wish for when you have, sort of a consolidated view. And it's one of the things we actually did think of a lot in 2008 and 2009, and we're thinking of again, frankly, as people are thinking about the OCC with ILCs and fintech charters and other things, and you start worrying about a regulatory arbitrage on one hand, from a regulatory standpoint. On the other hand, you're worried, you want the flexibility for what your actual business is. So I would say, it's great when it's a statute. You want the staffers for the Ag Committee to be talking to the Banking Committee if it's the Senate, and you want them to be able to say, can we do a joint hearing and hope the chairman, various chairmen get along, and direct their staff to work together. I mean, that was one of the things that happened for a while in Dodd-Frank, and I think we would have had a better bill if it happened all the way to the end of Dodd-Frank. I think the breakdown in that sort of communication was dramatically negatively impacted the result. But I think to answer your question very directly, congressional staffs can work together. Nothing prevents them from doing that. That's really helpful. Agencies, it's not hard for, as you saw it right here, for commissioners, and frankly, more importantly, deputy directors of divisions to talk together. And if you're representing someone who says, I have a problem with this agency, but this other agency we think kind of has it right for us, get them on the phone and tell them to talk to each other. You know, they're willing to do it. And that's one of the, it's a really basic thing, just, you know, suggesting they talk together, but it's amazing to me how little that's actually done. Oftentimes, the client is going from one meeting to the next meeting to the next meeting, but not saying, hey, I did 2 consecutive meetings. I really think you two should talk. Maybe can we do this over the phone or something? And it actually tends to help.
Yeah, I think I would add to that what has changed now is that there is greater coordination, starting with the chairman, and then, you know, seeing Commissioners Quintens and Peirce taking that leadership role because they've been empowered by the chairman of their agencies. And so that's what's really changed. I think going forward, to continue this, though, you really, not unlike a corporation where you've got so many different departments, you've got to build the infrastructure and create a coordination so it is part of the routine. And so that's really how you get better coordination. Not to leave it to luck that the chairman will get along or that the directors will call each other up, but build it into the infrastructure. Have this be part of the grain of the agencies, knowing that they're separate, but they can coordinate and work together as part of good government.
Yeah. And also add that I'm not sure it's actually worth the effort or would actually meet the goal we're trying to meet. I mean, you can have a giant agency and the divisions still act like little agencies within it. So it's not as if just putting them together will actually fix the problem. I think that what we're trying to get at is to have efficient regulation. And I think by doing that, we have to, you know, now that Dodd-Frank has settled in, now that all these rules are written, it's time to step back and look at the data we have so far and figure out how to efficiently move forward. Because ultimately, you want the regulation to match the risk. And up until now, we probably haven't had the data to do that. And so let's focus on that. And I think that will get us to the aim we're trying to get at by joining them without going through the mess of doing that and probably not actually achieving much.
Gotcha. Speaking of efficiently moving forward, unfortunately, we've got to end our panel. Thank you so much for your time. Let's thank our panelists.
And thank you, Ben. And on behalf of the MFA and Congressman Baker and BPC, thank you very much, panelists. Thank you, Ben, for moderating this. I also want to give a shout out to John Sharushian over here and Shai Akabas, staff here who have helped put all this together. And I appreciate all you coming out on a cold, rainy morning. But let me close by thanking once again Ariana for ironing this and making sure that Bipartisan Policy Center and manage. There are no wrinkles between us that we all believe, as Tyler said, in bipartisanship. Thank you very much.